This is Chuck Carnevale. I'm the Chuck in the Market's Up, Chuck. And, today's blog was viewed the recession is ending. And, of course, I don't know that that's really a valid statement or not, but we're starting to see more and more signs of some positive news and some, the federal beige book, as I talked about, report came out, and the Fed says that, they suggest that the recession is losing force in most parts of the company. It's far from being over, but at least it's on the moving in the right direction at this point. But one of the benefits, as I pointed out in the written blog, was that a lot of great companies have really gone out and leaned up their businesses and prepared themselves for the recovery, when it ultimately recurs. And it's not if it recurs. I'm convinced it's going to recur, the recovery I'm talking about. And when it does, that a lot of these companies that are so lean are going to see some really accelerated earnings growth. And one company I thought would be great to talk about in that regard would be United Technologies. This is a terrific company. They're well diversified in several sectors. They make carrier air conditioners, so they're going to certainly play in the housing improvement as that occurs, as housing prices are starting to firm up. They have their fire and security systems, their power fuel cells, and which they're working on the energy conservation side of what the world is looking at in the future. But they also have Otis Elevator and Sikorsky Aircraft. So it's a very well diversified company that kind of does business across the full gamut of what I would call the economy. When you look at United Technologies from the perspective of our fundamental analyzer software tool, I want you to notice that the company's been a very consistent grower. In the last recession, 2001, they actually had some pretty good numbers, and they came out of that very well. They are expected to have a down year this year, but they're still a very profitable year. The company has, a little debt in the balance sheet, but they do generate good cash flows. But one of the things that's really impressive about this company is that they've really leaned up their operation. So when you look at what happened to their stock price, they're normally a 17 multiple company. They're currently trading at around 11.8 or just under 12 times earnings. They have almost a 3% dividend yield. When you look at it from the history of their dividend over the last 14 years as this chart was produced, from January 31st, 1996, you can see they have a very consistent record of raising their dividend. They just recently raised their dividend at the end of 2008 again. The company over this 14-year stretch has averaged about 11% a year compounded. Add in dividends, and that number increases to 12.5%. And this is assuming you spend the dividends, by the way, not reinvest them. And that compares to an S&P of only 3.2%. So you have a great company here with a good track record, and I think the point is that the stock is obviously trading at one of the lowest valuations it's ever traded at, and earnings are expected to be down, and this may end up, coming to pass or not, but the real point is to focus on the recovery. And if they would get back to more normalized earnings and more normalized earnings growth, then I think you would, have to agree that the stock would be very, very cheap. At 17 times, last year's earnings, it's an $86 stock. You can currently buy it at $53 a share. So United Technologies is an example of a company that I believe is very well positioned for the recovery when it occurs. They've really leaned up their operation, and once business really begins to improve, they should really see some strong, margin improvements across many of the sectors that they operate in. The second example I have here is the retailer Kohl's. Kohl's has really done a lot of work on kind of revitalizing their business and organizing their inventory levels, changing their product mix, and really getting their business under control. And one of the things that I liked about this company is that they've been taking advantage of weaker competitors that have gone out of business. For example, Mervyn's in California went out of business. They ended up buying about 30 of their stores, and they're already starting to open them, but what they did was they cherry-picked. They bought the really profitable stores. So here's another company with a great long-term track record. It has had, some weakness during the recession, but once again, a very profitable company, and you can see the stock price reaction was much more draconian than the actual earnings drop was. And, the company has a great long-term track record. This is an 18-year chart here compared to the S&P. It's extremely well positioned, and as the economy improves, I think this company is going to see some, real strong margin enhancement and some real strong earnings growth and a reacceleration of their growth going forward. So these are great times to be buying companies like this as we come out of a recession. And the main point at the end of the blog that I'm trying to make here is that don't let the recession cloud your judgment. Stocks were overvalued back in the 90s and into the early 2000s, and those corrections were really valid. Today you've got stocks that, even though we've had a recession, we had some earnings weakness, the valuations are extremely low across the board, not just on these companies relative to their normal valuations, but many, many companies that I blogged about in the past. This is a great time to be a long-term investor in U.S. companies. As Warren Buffett said, last October in the New York Times, buy American, I am. And this is Chuck Carnevale. I hope you enjoyed today's post and look forward to talking to you again tomorrow.